If you're new to investing, the internet will tell you what to do. Buy index funds, start early, think long term, but nobody talks about what not to do. And the truth is, most beginners don't lose money because they picked the wrong stock. They lose money because they fell into the same traps that catch almost everyone at the start. In this video, we're going to break down the biggest investing mistakes beginners make. And more importantly, exactly how to avoid each one. Mistake 1. Investing before fixing your foundation. The number one mistake beginners make is jumping straight into the stock market before their finances are in order. They open a brokerage account while carrying high-interest credit card debt, with no emergency fund and no budget in place. Here's the problem. If you're paying 20% interest on credit card debt, no investment in the world is consistently beating that. The S&P 500 averages 6 to 10% a year. Your debt is costing you more than your investments are making you. Pay off high-interest debt first. Build an emergency fund of 3 to 6 months of expenses. Stabilize your income. Then invest. Mistake 2. Waiting for the perfect time to invest. You've probably heard it before. I'll start investing when the market drops. I'll wait until things calm down. I'll start next year when I have more money. This is one of the most expensive mistakes a beginner can make. The market doesn't wait for you to feel ready. And here's what the data actually shows. Time in the market beats time in the market, every single time. Missing just the 10 best trading days over a 20-year period can cut your returns nearly in half. The fix? Start now. Even $50 or $100 a month. Consistency matters more than the amount. Monthly investing builds the habit and compounds over time. Mistake 3. Letting emotions drive decisions. This one is responsible for more wealth destruction than almost anything else. When the market drops, beginners panic and sell. When the market is flying, they rush in chasing returns. Both are emotional decisions, and both destroy long-term wealth. Here's a fact that puts it in perspective. The stock market has existed since 1602, starting with the Amsterdam Stock Exchange. In over 400 years of market history, every single crash has recovered. Every bear market, every period of falling prices and investor panic has eventually reversed into a bull market. The investors who got rich weren't the ones who sold at the bottom. They were the ones who stayed calm, kept investing, and let time do the heavy lifting. The biggest difference between great investors and average ones isn't intelligence. It's emotional discipline. Mistake 4. Trying to pick individual stocks too early. A lot of beginners think investing means finding the next big company before everyone else does, so they spend hours researching stocks, watching tips on social media, and chasing whatever's trending. The reality? Even professional fund managers fail to consistently beat the market. Most beginners don't have the tools, the time, or the experience to do what professionals can't. The smarter starting point is index funds. An index fund tracks a market index, like the S&P 500, which follows the 500 largest companies in the US, or the FTSE 100 in the UK. Instead of betting on one company, you're spreading your money across hundreds automatically. When you buy one share of an S&P 500 ETF, like the Vanguard S and P500, your money is instantly diversified across all 500 companies. Warren Buffett himself has said this is the best approach for most people. Start here before you ever touch an individual stock. Mistake 5. Expecting unrealistic returns. Social media has a way of showing you the highlight reel. Someone turned $1,000 into $50,000 in 6 months. Someone called the crash perfectly. Someone is living off passive income at 25. What you don't see is the losses, the luck, and the survivorship bias. Only the winners tell their stories. The reality of the stock market is this. Realistic long-term returns sit between 6% and 10% per year on average. Some years are negative, some years are explosive. But over decades, this is what the market has consistently delivered. Building real wealth through investing is not a shortcut. It's a slow, steady, boring process, and that's exactly why it works. Mistake 6. Not diversifying. Putting all your money into one stock, one sector, or even one asset class is one of the fastest ways to get wiped out. Beginners often go all in on what's exciting right now. Crypto, tech stocks, a single company they believe in, without realizing that one bad quarter can cut their portfolio in half. Diversification is your protection. As your portfolio grows, spread across asset types. Index funds for the stock market, real estate for rental income and appreciation, commodities like gold as a hedge against inflation. The goal is that no single crash takes everything down with it. Mistake 7. Trying to buy the dip. Without a plan, buy the dip sounds simple. Prices fall, you buy more. Prices recover, you profit. But in practice, buying the dip is one of the hardest things to execute, and beginners almost always get it wrong. Here's why. You never know if the dip is the bottom. A stock can fall 10%, then another 20%, then another 30%. Fear clouds your judgment when prices are falling, and some companies never recover at all. The smarter approach is not trying to time the perfect entry point. Instead, invest a fixed amount every single month, no matter what the market is doing. When prices are high, you buy fewer shares. When prices are low, you automatically buy more. Over time, this smooths out the risk and removes the emotion entirely. Mistake 8. Ignoring tax-advantaged accounts. One of the most overlooked beginner mistakes is investing in a regular brokerage account before maxing out tax-advantaged options. Accounts like a 401k or IRA in the US allow your money to grow either tax-deferred or completely tax-free, depending on the account type. If your employer offers a 401k match, that is free money on the table. Not taking it is like turning down part of your salary. Always grab the employer match first and before anything else. Mistake 9. Investing without knowing your why. The last mistake is one most people never think about. They start investing without ever defining what they're actually investing for. Are you investing for retirement, a house, financial freedom, early retirement? Your answer completely changes your strategy. Someone investing for a goal 30 years away can handle more risk and volatility. Someone saving for a house in 5 years needs a completely different approach. Before you put a single dollar into the market, define what rich actually means to you. Is it security and peace of mind, stability, never worrying about money? Or is it lifestyle? Travel, freedom, options. Your definition shapes everything. The accounts you use, the assets you pick, and how you react when markets move. Outro. Investing is not complicated, but it does require patience, consistency, and the discipline to avoid the mistakes we just covered. The investors who win over the long run aren't the ones who found a secret strategy. They're the ones who stayed in the game long enough for compounding to do its work. And one last thing, don't forget that the most important investment you'll ever make isn't in the stock market, it's in yourself. Skills, education, and knowledge compound just like money does. If this video helped you, subscribe. We cover the real side of building wealth without the hype.